Hey there, welcome back to EPK Capital's Market Update. Today, I'm giving you a full rundown of yesterday's market movements and the key macro events that shook global markets on September 24, 2025. So let's jump right into the details of what was another tough day for investors amidst Federal Reserve uncertainty and changing global factors. Major market indices performance. Let's kick things off with the main numbers from yesterday's trading. US markets continued to drop for a second day, a first for all three major indices since early September. The Dow Jones Industrial Average fell 172 points, down 0.4% to finish at 46,121 points. Meanwhile, the S&P 500 dipped 0.3% to sit at 6,638 points, and the Nasdaq Composite decreased by 0.4%, ending at 22,498 points. This pullback followed a week of record highs, with all three indices still hovering near their peaks despite this recent downturn. Year-to-date performance has been solid, with the S&P 500 up 12.9%, the Nasdaq rising 16.5%, and the Dow increasing by 8.4%. Over in Europe, markets had mixed outcomes as investors processed Federal Reserve comments and local economic stats. Germany's DAX gained 0.23% to close at 23,667 points, and the UK's FTSE 100 rose 0.29% to 9,250 points. On the flip side, France's CAC 40 dropped 0.57% to 7,827 points, while the broader Stoxx Europe 600 index fell 0.19%. Asian markets echoed that mixed sentiment. Japan's Nikkei 225 barely budged, gaining just 0.01%, while Hong Kong's Hang Seng Index climbed 0.85% to 26,518 points, even with worries about China's policies. The Shanghai Composite Index edged up 0.47% to 3,854 points, but Australia's ASX 200 slipped by 1.04%. Federal Reserve policy developments. Yesterday's market direction was mainly driven by the uncertainty around Federal Reserve policies after last week's quarter-point rate cut. Fed Chair Jerome Powell made several statements that unsettled investors looking for more aggressive monetary easing. At an economic forum, Powell described equity valuations as fairly highly valued, which instantly affected market sentiment. He pointed out the Fed's challenging situation, trying to balance inflation risks with employment concerns, offering little insight on future interest rate directions beyond being data-driven. The Fed's newly appointed Governor Stephen Miron pushed for more aggressive rate cuts. He had voted against the 25 basis point cut, wanting instead a 50 basis points reduction. His stance contrasts with other Fed officials like Alberto Musalem and Beth Hammack, who prefer a more cautious monetary policy. Currently, market participants are pricing in a 94% chance of another quarter-point cut at the October Federal Open Market Committee meeting, with about 92% odds of more easing by year-end. But Powell's cautious tone on inflated stock valuations raises doubts about aggressive rate cuts. The political side of Fed policy remains vital, with President Trump pushing Powell for larger rate cuts. Trump deemed Powell too late to act and has been considering potential replacements when Powell's term expires next year. This heightened political pressure complicates the Fed's decision-making. Bond market and interest rate developments. Yesterday, Treasury yields climbed as investors reassessed the likelihood of the Fed easing further. The two-year Treasury note yield rose to 3.6%, and the 10-year yield increased to 4.14%. This reflects ongoing concerns about inflation's potential persistence. The yield curve's movements suggest that while markets are betting on near-term cuts, long-term inflation expectations remain high. Worries about the inflation impact of trade policies and tariffs continue influencing the economy. Fed officials recognize the tough balance between promoting jobs and controlling inflation. Recent economic data has been mixed. Manufacturing PMI met expectations at 52.2, while services PMI slightly missed forecasts at 53.9, showing slower growth in that sector since June. Crude oil and commodity markets. Oil markets had some dramatic shifts yesterday, with crude prices spiking about 3% to hit 7-week highs. Brent crude futures shot up to $69.31 per barrel, and West Texas Intermediate rose to $64.99. This rally stemmed from several supply-side factors tightening market conditions. A surprise drawdown in U.S. crude inventories was a key catalyst, with the Energy Information Administration reporting a decrease of 607,000 barrels for the week ending September 19. This was a stark contrast to analysts expecting a 235,000 barrel increase, raising supply concerns. Geopolitical tensions are still bolstering oil prices. Negotiations on restarting oil exports from Iraq's Kurdistan region have stalled, halting about 230,000 barrels daily since March. Disagreements regarding producers' debt repayment have complicated pipeline shipments to Turkey. The Ukraine-Russia conflict adds further uncertainty. Ukrainian forces intensified drone strikes on Russian energy infrastructure, aiming to curtail Moscow's export revenues. NATO has promised a strong response to Russian airspace violations, and Russia faces domestic fuel shortages that might trigger export curbs. Trump's ongoing comments about European energy independence from Russia also shape market attitudes. His calls to NATO allies to cut energy ties with Russia and take military measures against aircraft breaches have heightened geopolitical tensions. Venezuela's oil sector is also feeling the pinch, as Chevron announced it will export about half of the 240,000 barrels a day it produces due to new U.S. restrictions on heavy crude shipments. Cryptocurrency market analysis. The cryptocurrency market faced another volatile day, with major digital assets showing a mix of trends but leaning negative overall. Bitcoin traded around $112,975, basically unchanged in the past 24 hours, but down 2.8% for the week. This leading cryptocurrency is struggling near key technical levels as investor demand shifts. Ethereum faced sharper losses, down 0.3% over the last day to $4,178, and down 7% for the week. The second largest cryptocurrency is particularly impacted by concerns over waning altcoin strength, with its season index dropping from 77 to 70 recently. The broader crypto market cap dipped 0.1% to $3.99 trillion, with trading volume steady at $163.7 billion. 8 of the top 10 cryptocurrencies saw negative performance in the last week, suggesting widespread weakness in the digital asset sector. Solana declined 2.9% to $212.74, bringing its weekly loss to 9.2%. Dogecoin led weekly losses among major cryptos, falling 8.5% to $0.2429. However, some altcoins like BNB gained 6.6%, and XRP rose 4.2% weekly. The recent crypto volatility is linked to a massive liquidation that wiped out over $1.8 billion in derivative positions across the sector. This event highlighted the high leverage levels in the crypto space, nearing levels seen before the last major bear market in 2021 and 2022. Concerns about large investors pulling back and moving assets to exchanges raise worries about possible increased selling pressure. The market remains responsive to macroeconomic factors, particularly Fed policy and rate expectations. Corporate earnings and individual stock movements. Some notable corporate news affected individual stock performance yesterday. Micron Technology declined 2.8% despite reporting better than expected profits and revenue, along with an optimistic forecast that beat analyst expectations. This drop reflects high market expectations for tech firms and concerns over elevated sector valuations. Homebuilders enjoyed a positive boost from stronger than expected new home sales data for August, suggesting resilience in the housing market despite high rates and affordability issues. On the downside, Freeport-McMoRan faced significant losses, plunging 17% after the mining company forecasted a 4% drop in copper sales for the third quarter. The firm also projected around 6% lower gold sales, citing operational issues at its Indonesian sites. On a brighter note, Lithium Americas skyrocketed 95.8% after reports that the US government might take an ownership stake in the Canadian company, which is partnering with General Motors on a lithium project in Nevada. This highlights the strategic importance of critical mineral supply chains. Chinese tech companies in New York had mixed results. Alibaba announced over $53 billion in AI and cloud investments, causing its shares to surge 8%, while others like Baidu and PDD also gained. Tesla went against the broader tech trend, rising 4% on ongoing optimism regarding its AI and self-driving initiatives. Global economic and political developments. Several key political and economic events influenced market sentiment yesterday. President Trump made impactful comments at the United Nations General Assembly, urging NATO allies to act against Russian aircraft violating alliance airspace and insisting Ukraine reclaim all occupied territories. These hawkish foreign policy remarks fueled geopolitical risk premiums in various markets. Trump's pressure on the Federal Reserve remained significant, as he reiterated that Powell should push for aggressive rate cuts. These political dynamics around monetary policy add further uncertainty for market expectations regarding future Fed actions. European economic data revealed mixed outcomes, with Germany's PMI figures exceeding predictions while France presented weaker readings. The varying economic performances across the Eurozone complicate the European Central Bank's policy decisions. China's recent financial measures failed to meet market expectations, initially dragging down Hong Kong markets. However, the China Securities Regulatory Commission's promise to improve performance among listed companies and attract global capital later provided some support. Surprisingly, Sweden's central bank cut its key interest rate by 25 basis points to 1.75%, targeting economic growth while trying to manage inflation. This decision underscores growing concerns about economic momentum in the Nordic region. Sector performance analysis. The technology sector kept facing challenges, with many Magnificent Seven stocks either flat or declining. Investors are starting to question the sustainability of AI-related investments and their impact on earnings. Nvidia, despite announcing key partnerships and investments, saw its stock drop as worries arose about the structure and energy demands of its $100 billion OpenAI collaboration. On a brighter note, the energy sector shone, with oil companies benefiting from rising crude prices. Energy stocks in the S&P 500 excelled as supply concerns and geopolitical tensions boosted commodity prices. Defense and aerospace stocks gained ground following Trump's remarks on NATO's response to Russian provocations. The Stoxx Europe 600 Aerospace and Defense Index rose 1.39% as investors anticipated possible increases in defense spending. Mining companies had mixed performance. Copper miners like Antofagasta, Anglo American, and Glencore rose with copper prices while others faced operational challenges and altered guidance. The financial sector felt the strain from rising bond yields and worries about the pace of Fed rate cuts. Banks are sensitive to interest rate expectations, with sector performance closely tied to yield curve trends. Upcoming market catalysts. Looking ahead, several key events are set to steer market direction soon. The most significant will be Friday's release of the Personal Consumption Expenditures Price Index, which is the Fed's preferred measure of inflation. Predictions suggest core PCE will increase by 0.2% month-over-month, with an anticipated annual rate around 2.9%. This inflation data is crucial for expectations about future Fed policies. Signs of rising price pressures might make investors rethink aggressive rate cut expectations, while weaker inflation could support ongoing monetary easing bets. Several Fed officials are scheduled to speak this week, offering insight into their thinking. Markets will especially focus on comments from voting members of the Federal Open Market Committee. Corporate earnings keep rolling in, with Costco about to report after markets close today. Analysts anticipate strong sales as consumers seek value amidst economic uncertainty. Retail performance will shed light on consumer spending trends and overall economic resilience. Oil markets will also be watching for further geopolitical developments, especially regarding the Russia-Ukraine conflict and Middle Eastern supply issues. Increased tensions could further lift energy prices. Technical analysis and market outlook. On the technical side, US equity indices are in a fragile position after drifting down from recent highs. The S&P P500's retreat from its all-time peak has it testing short-term support, with the 50-day moving average acting as potential backing. The Nasdaq 100's market structure changes are particularly notable, showing lower highs and lower lows as it nears its ascending trendline from early September. The 14-period RSI has dipped below 50, hinting at a near-term bearish momentum shift. Key resistance for the Nasdaq is at 24,667 before refocusing on the all-time high. A drop below current trendline support could signal a deeper retreat toward 24,200, while a critical support zone lies at 24,000. In currency markets, the dollar is holding strong against most majors, with the dollar index around 97.25. The euro managed slight gains thanks to positive German PMI data, while the British pound remained resilient despite mixed UK economic signals. Gold and silver pulled back from recent highs as rising yields and dollar strength weighed on precious metals. Yet, ongoing geopolitical tensions and global economic uncertainties provide underlying support for safe haven assets. Risk assessment and market sentiment. Market sentiment currently shows a cautious optimism mixed with various uncertainties. High stock valuations, Federal Reserve policy unpredictability, and ongoing geopolitical tensions create a more risk-averse environment compared to earlier exuberance. Volatility indices are elevated but not extreme, indicating markets are pricing in continued uncertainty without mass panic. However, the narrow concentration of gains in a few tech stocks leaves markets vulnerable to sector-specific disappointments. The disconnect between bond and equity markets is noteworthy, with rising yields potentially challenging stock valuations if the trend continues. The dynamics between monetary policy expectations and asset prices are vital for short-term market direction. International events, especially concerning trade and geopolitical issues, remain significant risks for global markets. The interconnected nature of today's markets means developments in any region can swiftly affect global sentiment. Conclusion and market outlook. Yesterday's market movements solidified key themes that will likely capture investor interest in the weeks to come. The Fed's cautious stance on monetary policy, despite rate cuts, has cast uncertainty on the potential pace and size of future easing. This unpredictability is a challenge for markets used to stable central bank support. The strength of the energy sector amid geopolitical tensions shows how quickly market dynamics can react to supply disruption and political shifts. Oil's rise to 7-week highs highlights the importance of geopolitical risk in commodity price movements. Technology stocks stand at a critical point as investors question whether significant AI investments will yield sustainable growth. The recent softening in the sector, despite continuing positive news, suggests valuations may be ahead of fundamentals. Global markets are navigating a complicated landscape where traditional correlations between asset classes are being tested by unique policy and geopolitical factors. The upcoming inflation report and Fed communications will play crucial roles in defining the next phase of market direction. As we enter the final quarter of 2025, markets will need to maintain their momentum despite high valuations, policy ambiguities, and geopolitical strains. The pressure on corporate earnings to justify stock prices will be intense in the upcoming earnings season, while macro data will continue to shape monetary policy expectations. That's it for our deep dive into yesterday's market actions and the major macro events influencing global markets. The ongoing interplay between Federal Reserve decisions, geopolitical developments, and corporate fundamentals keeps creating a dynamic trading environment that calls for careful attention to many factors. Stick around for more insights into these evolving market themes, and always remember to do your research and consider your risk level before investing. The market is in a critical phase where policy choices and international events can shift sentiment quickly, presenting both opportunities and risks for investors. Thanks for tuning in, and we'll catch you tomorrow with another thorough market update that covers all the key developments for your investment decisions. Just a quick note, this video is for educational purposes only and isn't financial advice. For personal financial guidance, please reach out using the details in the description or consult your financial advisor.